Trading with and against the trend. What's the difference? What's the first thing you notice when you open a chart? Every trader is consistently monitoring price changes, buying activity, and market trends. And if you're just starting out, when you first open a chart, you might see only chaotic lines and movements. But if you look more closely, it becomes clear. The market never moves randomly. It has a direction, its own dynamics, its own rhythm, and it's understanding this rhythm that helps you distinguish a trader who is acting consciously from one who is simply clicking buttons at random. Today, we'll take a detailed look at two main approaches: trend trading and counter-trend trading. These strategies are often contrasted, but in reality, both have their place. It's important to understand how to use them, their advantages and their risks. We'll start with the simplest thing, with the definition of what is a trend. A trend is a directional movement over a period of time. When the price rises, it's an uptrend. When it falls, it's a downtrend. Understanding the trend is the foundation of all trading. Many beginners make the mistake of trying to catch a reversal when the market isn't even going to stop yet. And here's why. It's important to explain why trend trading is often more understandable and logical for beginners. When trading with a trend, you leverage the strength of an existing movement, just as it's easier to go with the wind than against it. In the market, it's more profitable to trade in the direction of an established trend. This is because once a trend forms, its further development is often more predictable than a sudden change in direction. For beginning traders, following the trend helps them better understand the market and gain valuable experience. And now it's time to make an important addition. If you want to quickly understand all the nuances of trading, gain experience, and also see visual analysis, the practical examples, then I'll attach a link to my Telegram channel where I share useful materials every week and hold giveaways where you have a chance to win 100% of your deposit. Leave a comment saying I want to enter the giveaway and I'll send you a special link. In the channel, you will find materials that will help you quickly grasp. The link is in the description below this video. Click through and join. It's a great way to stay motivated and gain new knowledge. Now, let's continue. Despite its appeal, trend trading is not without risks. Sharp price movements can make entering a trade mid-trend dangerous, as it's at these moments that corrections, temporary price pullbacks against the main direction often occur. These corrections are what attracts counter-trend traders. The idea is that prices can rise or fall forever, and those pullbacks can create profitable opportunities. However, counter-trend trading requires significant experience and perseverance and the ability to control the market risks. It's important to remember that trading involves financial risk and should be approached with caution. No method or strategy guarantees results. A trader's task is to minimize mistakes and allocate resources wisely. Even when you're trading with the wind, the market can reverse sharply. That's why proper capital management is the best place to start. Trading against the trend often entices beginners because it seems more profitable. The idea is that if the price has been rising for a long time, it's about to fall. But there's a practical caveat. To truly counter the trend effectively, you need to rely on technical analysis. This means working with support and resistance levels, zones where the price has repeatedly reacted. You need to be able to spot where buyers or sellers are starting to weaken in terms of specific techniques. Trend trading is usually built around confirmed signals. This could be a breakout of a level where the price confidently consolidates above or below a significant mark, or the use of indicators that help determine the strength of the movement. For example, simply moving averages allows us to see the overall market direction, And when the price holds above them, it signals an uptrend. When trading against the trend, oscillator indicators are more often used, indicating that the market is overbought or oversold. This helps identify points where the price may pull back. It may seem like trading and against the trend is worlds apart, but in reality, many experienced traders use both methods. They may trade with the trend most of the time, but sometimes when they see clear signs of weakening momentum, they'll use a counter-trend trades for short-term corrections. The most important thing to understand is that there's no one magic method that works for everyone. Everything depends on how you trade, how you analyze the market, and how well you manage your risks. I advise beginners to focus on trend trades. This will help develop the habit of moving with the market, not against it. Later, when you feel confident and recognize patterns, you can try a more complex approach. But even then, remember, trading against the trend always requires extra caution. Guys, take your time and don't look for easy ways. Study the charts, analyze your trades, and learn from mistakes. Every practice brings you closer to the understanding and how the market works. The better you understand it, the easier it is to make an informed decisions. And while following the trend may seem boring to some, it's often the foundations upon which more complex strategies can be built. If you want to stay up to date with all the latest news and get more practice and useful material, be sure to subscribe to my Telegram channel. There, I share analysis and give useful advice. The link is in the description down below. Click it right now. It's the right step for anyone looking to advance their trading.